Hello, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 144, titled After Hours and Pre Monday Morning Market Trading Bid Ask Spreads. Is this appropriate for retail investors? Well, we've all heard about after hours and pre market trading, but what's really going on here? And is this appropriate for most retail investors? That's the topic of this podcast. So, what is the dilemma facing retail investors? Well, unfavorable bid ask spreads pre market and after hours trading is certainly the biggest of them all. So, how do we manage these wide spreads? And is after hours and pre-Monday morning market opening trading appropriate for most retail investors? Now, there's always going to be situations where it is appropriate for certain sophisticated, more experienced traders. But we're talking now in this particular podcast about a majority of retail investors. So, what actually is after hours trading? Well, this is the exchange of securities, just like during market hours, but outside the exchange's normal trading hours, which is generally between 9:30 a.m. Eastern Time and 4 p.m. Eastern Time, Monday through Friday. Trading is facilitated by an electronic communication network, ECN for short, which allows buyers and sellers to connect and match up their buy-sell orders for every particular security. Now, after hours trading begins at 4 p.m. Eastern Time, when normal hours end, and it ends at 8 p.m. So 4 p.m. Eastern Time to 8 p.m. Eastern Time. Now let's talk about pre-market trading hours. That begins 8 a.m. And ends at 9:30 a.m. Eastern Time when normal trading begins. So those are the hours of availability for these aftermarket and pre-market trading hours. Now let's talk about the volume and the spreads, the bid-ask spreads during after hours and pre-market trading. Well, the issue here is that there are many, many fewer players during these hours. It's all about the liquidity. Now, in the BCI methodology, we have guidelines for the liquidity of the underlying securities, at least 250,000 shares being traded on average, and also the liquidity of the options. We require an open interest of at least 100 contracts and or a bid-ask spread of 30 cents or less. So the liquidity will often dictate the favorable trade executions or lack thereof, depending on how much volume there is for those particular spreads. So because there are many fewer players, that becomes an issue for the bid-ask spreads, and that's why they become much wider. Now, there's also a greater propensity for price fluctuations during these hours of low liquidity, and that creates more risk for us, the retail investor. Now, for those who do trade after hours and pre-market, they would make the case, so I want to give you both sides here, that there are actually opportunities during these hours that would not be available when there's much greater liquidity during normal market trading hours. So, as I said, there's always a pros and a cons. What I'm talking about now is, generally speaking, for most retail investors, there's much greater risk trading during these hours, and it's all related to the lack of liquidity. So how are these bid-ask spreads published? Well, the published bid generally is the buy order with the highest price, and the published ask price is the sell order with the lowest price. And exchanges attempt to match up these orders. During normal trading hour, which, as I said before, has much greater volume, there's a much greater opportunity to execute these trades with much smaller bid-ask spreads. So again, the smaller the spread, the greater liquidity, the better the opportunities for us to get good price executions. Now, with these lower after hours liquidity, there could be large gaps, and usually there are large gaps between those published bid and ask prices. So, why are the prices so wide before and when markets first open on Monday morning? Well, the market makers are really looking to see how the order flow is moving. So when setting their bid-ask spreads before the open of regular trading hours, particularly Monday morning after the long weekend, market makers may take some caution and they wait a little bit until they see the direction of the order flow before setting smaller bid-ask spreads. And that explains why there are wider spreads at the open. And during the course of the trading day, once the market maker sees how the order flow is moving, then they're more comfortable setting up smaller spreads. They're protecting themselves. So when they're determining the implied volatility levels, they will, until they could see what's going on, there will be some uncertainty, and therefore they will be more cautious and have wider spreads. So if the spreads are too tight before they determine the liquidity, they may get stuck trading too much on one side of the market. They don't want that to happen, and therefore we will see much wider spreads before the market opens and early in the trading day. And for those of you who are also watching this podcast, I have a screenshot, just a little snippet of an option chain showing the volume all the way to the right of zero volume to one contract. So very low volume. I look more at open interest than volume, but it just goes to show you at the beginning of the day. And you could see bid-ask spreads running anywhere from 50 cents up to nearly $2. So once again, early in the trading day, when volume is very low, we would tend to see these very wide spreads. That's why I don't like trading early in the day. Also like to get the market settled after the computerized institutional trading. So I like to place my trades somewhere between 11 a.m. Eastern time and 3 p.m. Eastern time. So the bid-ask spreads would tend to be tighter, and we can kind of get an idea of the direction of the market, and we stay away from that high volatility of the institutional computerized trading, which takes place early in the trading day and then once again later in the trading day. So kind of summarize here, this type of trading after hours and pre-market is not appropriate for most retail investors. Institutional investors who do these kinds of trades have a tremendous amount of resources that we do not, and it's very, very tough to compete against them. So having more liquidity is to our advantage, to the advantage of the retail investor. Once again, let me reiterate, in my humble opinion, the best time to trade is between 11 a.m. Eastern time and 3 p.m. Eastern time. Before I go, ladies and gentlemen, let me mention our two best packages for learning covered call writing and selling cash secured puts. First, our BCI package, which is an acronym for our best and most comprehensive educational product, investment product ever created by the blue collar investor. It has 18 components, 6 online video courses with downloadable workbooks, 6 calculators invented by the blue collar investor, found nowhere else, 5 of our best selling books on both covered call writing and selling cash secured puts in ebook format, and our 13-month of premium membership, which has in and of itself over 200 components, including well over 200 training videos, reports of eligible option selling candidates, and dozens of other files. Also, our second package I want to mention is our trade management calculator package, which includes our recently developed trade management calculator, where you can enter trades, get initial trade and portfolio calculations, adjust your trades with over 20 different exit strategies between the two strategies, and get final post-adjusted trades along with final portfolio calculations. It comes with the PDF version of my 8th published book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts, along with a 28-page user guide. Go to our website, thebluecollarinvestor.com. Click on the link at the top that says Best Discounted Packages. You can also get all our educational products individually by going to thebluecollarinvestor.com store. So there you have it, ladies and gentlemen, BCI podcast number 144, after hours and pre-Monday morning market trading, bid-ask spreads. And folks, I hope you enjoyed this presentation, and more importantly, I hope it puts cash in your pockets. As always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.